All right. Thank you for joining us for Coffee and Cap Rates. Our main program today includes a presentation about New York City. And right after that, we're going to jump into a panel discussion with our esteemed panelists who agreed to be here today. Rob Deckey from Invesco, Sharif Mitchell from Dantes Communities, and Brian Haber from PCCP. We're truly grateful for your participation, and thank you so much for contributing your time and being here today to educate us. I want to say a special thank you to my colleagues, David Baruch, Adam Pollack, Remy Mendel, and Ivan Petrovich for putting this presentation together. In addition, if you have any questions at any time, you can ask it through the chat. We will try to address as many of the questions as possible throughout the panel discussion. And if we don't, we'll try to send you some answers later on. Our company, Ariel Property Advisors, is a real estate investment services company that has the passion for data. We found that building owners are interested in specific knowledge when they want to sell, refinance, or recapitalize their buildings. Yet, this information is not always available. And so our research analysts and brokers turn that excitement for data into insights that our clients can leverage and allow for the most effective transaction execution when working with our teams. To get our latest insights, please visit our website. It's presented here on the screen and in the chat, and you can download all of our reports, and now it is for free, so please take advantage of that. Our company, Ariel Property Advisors, is also thrilled to be a part of a larger community, and over the years partnered up with Legal Outreach. And we love the organization because Legal Outreach truly raises the bar for all of us as a community, and they're a true New York organization. I've been especially impressed by the founder, James O'Neill, and I'd like to invite James to give us a few words of wisdom about the organization. James, the floor is yours.
Thank you so much, Simone. Really appreciate the support that we've gotten from Ariel Property Advisors over many, many years. And as many of you know who've attended previous events, Legal Outreach is actually a college access and college prep organization. Our mission is to change the educational direction and trajectory of urban youth. How do we do so? Hear the words of 3 of our students who've graduated and completed our program and are now in college.
I don't think that I would have been as prepared for college without LO. I think a lot of the programming fills in the critical thinking gaps that I personally didn't get from my high school curriculum.
The people that I see around me are people that work in cleaning houses or doing jobs that don't necessarily pay you as well as you deserve for the amount of work that you do. And so internships were really useful in order to see how much we could accomplish.
I didn't know anything about the law or the legal system or have any ideas of the opportunities that I could pursue through law. So the impact of the program from the beginning to the end and the people that I've met through the program has definitely changed the course of my life.
So there you have it, 3 short and sweet statements from Legal Outreach graduates expressing their appreciation for the impact that the program has had on their lives. In like manner, I'd like to take this opportunity to express my thanks to Ariel Property Advisors for partnering with us to help produce these types of results. We couldn't do this work without committed partners and sponsors from the private sector. I'm also grateful to many of you who are in attendance today. Because you were willing to take 2 minutes out of your day back in October to vote for us, Legal Outreach was chosen as the Chick-fil-A Northeast Region True Inspiration Award winner for 2022. By casting your vote, you helped us secure the first place prize of $150,000, which is really being used to support our programs and our students. Finally, if you're interested in becoming more involved with us, there are a couple of ways you can do that. Obviously, you can always donate to the organization. All you have to do is go to our website, which is legaloutreach.org. Or if you would like to become more personally involved or have your company become more personally involved, just contact me directly at joneil@legaloutreach.org. That information is going to be in the chat. So again, thank you all so very much for supporting us. And we're proud again to be that True Inspiration Award first prize winner.
Thank you, James, and thank you for bringing these videos and showing the wonderful work that the students are doing. I can tell you from our experience, it's one of the more rewarding internships that we have here at Ariel, where all of our employees, analysts, and brokers get around that effort and get engaged in really trying to raise the bar. So thank you for what you're doing, James, and I recommend that you touch base with James and get to know more about the organization if you have passion for what they do. So thank you for that. That's going to we're going to start with a presentation. A presentation about New York City is going to take about 15 minutes, and we're going to jump right into the panel discussion at the end of the presentation. Again, if you have any questions, feel free to put it in the chat. So let's get started with a New York City presentation, and here we go. Yes, a bit dramatic, I know, but I couldn't help it. So when you look at the vacancy rate and other market indicators over a time period, to me it looked a lot like an EKG of a patient who suffered a heart attack, and that was our New York City in 2020. The good news is that we've survived that. New York City survived that and started making its way towards real recovery last year. So how did the vacancy rate decline so quickly? The lower rents contributed to people coming back at the fourth quarter of 2020, but the availability of the vaccine was the tipping point when people started migrating in a bigger way in 2021. As a result, vacancy rate dropped below 2% and residential rents grew by 24%. To me, that was a very encouraging statistic, but the next set of data got me really excited, and that was all about condominium sellouts. The third quarter of 2021 has been the highest in number of condo sales in the past decade, and that momentum continued through the fourth quarter and continues so far this year. But in addition, condominium pricing jumped 7% compared to the year before. And for those of us who want to write off 2020, it was still 4% above 2019. And so very strong residential recovery in New York City in a very short period of time. When you look at fundamentals and stronger fundamentals, it brings us to discuss the investment in the city, and that was $28 billion, or 42% more than 2020. Still, 2021 was one of the lowest years in the past decade when it comes to dollar volume of transactions. And I wanted to learn more about any momentum moving into 2020. And so when we looked at contract activity, we found that 2021 ended up with billions of dollars in contract going into and expected to close this year in 2022. And that's in addition to a very robust fourth quarter. In fact, the best quarter in the past 6 years. So the momentum is here for a great investment sales market, we believe, in 2022. Now, we all know that leverage drives real estate. So we wanted to take a quick look at the lending environment in 2021, and we realized that U.S. capital markets are back in a big way. After a real slowdown in lending in 2020, lender volumes have rebounded across all product types throughout the country, and New York City was no exception. Yet the cost of capital dropped amongst all lending institutions as a result of a super competitive lending environment, as well as very low interest rates. And so our capital services professionals placed bridge loans as low as 5% and all the way a little bit less than 3% in some cases, in cases of bridge to perm solutions. So very low interest rate environment and very robust one last year. Now, investors' appetite in New York City was diverse. So let's talk a little bit about asset classes. And we start with the multifamily asset class because we believe it's the lifeblood of investing in New York City. And multifamily investment in New York City grew to $7.2 billion last year, a 56% year-over-year increase. Yet the market was a tale of three segments: luxury buildings, affordable housing, and rent-stabilized buildings also this time around. In the luxury apartment segment, Brooklyn and Manhattan led the way. It's usually the case. RXR in Brooklyn, for example, purchased the residential portion of 87 J Street for a reported $222 million. And in Manhattan, two large luxury apartments went into contracts. Remember, the momentum went into contract in 2021 and are ready to close this year. One of them is the American Copper building that is being sold to Black Spruce Management for $850 million. The other building is Gary Apartments or 8 Spruce Street, which Blackstone is buying for $930 million. So again, very strong momentum going into the year in the luxury apartment sector. The second segment, which has done extremely well throughout the pandemic, is affordable housing. And in 2021, consisted of 25% of all multifamily transactions. Two large transactions that took place is the Starrett City portfolio in Brooklyn, which was a partial interest sale that totaled $1.8 billion in total capitalization, and pretty much the largest sale of the year. And the Bronx 2000 portfolio, which our company represented as a broker and sold to Invesco and Fairstead, and closed for a reported total capitalization of $350 million. This was a project-based Section 8. Now, if you want more about momentum, you can talk to my partner, Victor Sozio, who is leading now 3 other 9-figure affordable housing sales, which again speaks for the momentum in the multifamily market and in this specific segment as well. Lastly, and after a few years of very low transactions in the rent-stabilized asset class, because of HSDPA, because of the Housing Stability and Tenant Protection Act of 2019, we saw a year where we could enjoy some clarity when it comes to pricing. In essence, we, sellers, buyers, and lenders became a little bit more comfortable pricing rent-stabilized assets. About 20-25% of this specific segment was in rent-stabilized, and most of it in smaller deals. Now, we chose to put 2 larger deals here for you as an example. One is the Briarwood portfolio, and another one is another Queens deal that was predominantly rent-stabilized that sold in 2021. So as a result of these investments, we remain bullish on New York City's multifamily investment moving forward, and multifamily pricing represents another compelling argument for investors. And the detailed pricing is in our reports. As I mentioned, you can download them. It's in the chat room at this point. But here in this presentation, we focused on Manhattan below 96th Street for multifamily pricing, as it is a leading indicator. And pricing in that sector increased on a price per square foot year over year. And the reason is the improving fundamentals, the rental, the higher rents, the lower vacancy, and so on. Still, when you look at the 10-year chart, you can see that the average price per square foot in 2021 was at its lowest point compared to the rest of the decade. Therefore, we expect that pricing will get stronger for multifamily in New York City in 2022 as investors realize the lower bases in New York City. Now, it's all relative, and a very smart man said that before. And the national pricing for multifamily improved. The national pricing improved throughout the pandemic, and as you can see here, cap rates have dropped over that same period of time. Yet in New York City, pricing actually declined as cap rates went up at the same period of time. In fact, for the first time in a very long time, we see this gap inversion in cap rates between the national multifamily and the New York City multifamily market, which to me is very interesting. And so this is another observation that the multifamily market in New York City might be undervalued today. So if multifamily is the lifeblood of investing, land is the foundation, and this time foundation means a lot, as the 421A tax abatement is set to expire in June, and we all know that it is not financially feasible to build residential rentals without that tax abatement. But the governor, to her credit, provided some clarity as to what the tax abatement could look like. Still, developers need the certainty when it comes to buying land and building residential rentals. Therefore, we might see slowdown in land transactions in locations that are slated for residential rental development in this year. Well, you might ask me, what about the condo or prime condo locations, prime land locations? And I hope you got a little bit excited when we spoke about the condo sellouts, which are usually an indicator for land prices and transactions. But when we reviewed land values, very similar to multifamily, pricing showed no growth last year. In fact, land prices in Manhattan were at one of its lowest points in a decade. And so we believe that land represents a great investment opportunity and might trade at a premium in 2022 in prime Manhattan and Brooklyn areas. So we spoke a lot about residential. Let's talk briefly about retail, office, and hospitality. And retail suffered pre-pandemic, and the pandemic accelerated some underlying issues in this specific asset class. When we looked at the Google mobility reports, we were encouraged to see that there was 57% growth in that specific in retail. And we also saw that restaurants did 4x the amount of reservations over the course of 2021. We're still below pre-pandemic levels, about 30% below pre-pandemic levels. And for that reason, much growth is expected in that arena once the pandemic subsides further. Office attendance, while got hit hard during the pandemic, did grow in 2021, yet office attendance and absorption, very similar to retail, are well below pre-pandemic levels and affected transactions in general. There's an exception to that rule. Well-located office buildings, prime tenancy, have benefited even in 2021. So an example is 441 9th Avenue, which sold for over $1 billion, over $2,000 a foot. It's a Class A building with a corporate tenant or corporate tenants like Peloton. The last thing is just a word about travel, tourism, and hotels. This is one of the segments that is an inseparable part of New York City's economy. Hotels, significantly lag behind pre-pandemic fundamentals, unfortunately, and therefore we do expect a major wave of economic growth in New York City when this specific sector recovers. but it might take months, maybe even years. When it happens, it's going to be positive for the city. I don't think it can go down even further from where it is today. Bright spot is industrial warehouse and self-storage. 2021 has been a banner year for that specific sector. About $5 billion of transactions, close to, pretty much the best year in 10 years. One outlier transaction was the Manhattan mini storage transaction that was sold for a little less than $3 billion. But even when we take out that transaction, the statistics show strong industrial warehouse self-storage statistics. And in addition, there has been some related transactions this year in prior years that are in the pipeline for development. And therefore, we do see strong growth continuing in industrial warehouse and self-storage moving forward. That brings me to the watch list and the brief takeaway. And the watch list in New York City consists of some macro items like interest rate and inflation, yet the real uncertainty in the city comes from COVID-19 and the political environment. And so when we talk about COVID-19 or the COVID variants, at this point, experts are telling us that we're at the tail end of this pandemic, and we at Ariel, being optimistic, hope to see you in person in July for our next Coffee and Cap Rate presentation. The local and state legislation is a little different. One of the things that is on investors' mind is the good cause eviction, which is considered a universal rent control. And again, investors are watching carefully to see what Albany does about it. Mayor Adams, people are telling us it could be great news for real estate landlords, but also great news for tenants, as he's a pro-business, but also pro-affordable housing. Both are needed in the city. We spoke about the 4021A, the need for clarity and certainty there. The J51 tax program was reinstated by the city. We think it's great for landlords and tenants as buildings could be improved. And Local Law 97 is the energy efficiency bill that's going to come in the next few years. It's a big to-do for landlords, improve their buildings, improve their energy efficiency, and a must-do. You can use CPACE lending for that, which is a specific type of lenders, and we can help you navigate this if you need as a landlord. Yet the more obvious items on the watch list is, interest rate hikes, and that means higher cost of capital, which is not a great thing for real estate, clearly, and inflation. Inflation could be good for real estate, as real estate is considered inflation hedge, therefore can be viewed as an accelerator for activity moving forward this year. And I bet that we saw some of this activity last year as people, projected the inflation coming in. And the last thing on the watch list is the dollar, the weaker dollar, so to speak. And we've seen international family offices and high net worth coming here. New York City is considered a safe haven. And so we believe to continue to see the same money from international sources coming here because of the weaker dollar. The one takeaway is that New York City's real estate showed very strong signs of recovery, but still could be somewhat undervalued. And the numbers and investor sentiment tell us that that recovery will continue through 2022. So from a New York City perspective, we are very bullish on the real estate market and moving forward. And this really concludes my presentation and brings me back to our panelists, and we'll talk about with them in a minute. And I wanted to mention something to you. Mayor Adams was one of our panelists in our Coffee and Cap Rates in the past, yet now he's the mayor of New York City. And so Rob, Brian, Sharif, if you ever had a dream to become the mayor of New York City, being on the panel here on Coffee and Cap Rates is a great step in the right direction. In addition, if you have any questions, just let us know through the chat, and we're going to start and get going with the panelists. And I'd like to invite first each one of you to tell us a little bit about yourselves. And I want to start with you, Rob. Tell us a little bit about yourself. Tell us a little bit about Invesco, and tell us a little bit about if you want to run for mayor in the next elections.
I'm going to start reverse order. I do not want to run for mayor, although I think it is a great city, and so excited that people are back. I worked on Wall Street for a number of years, and then have been investing in New York City real estate for about 20 years. I've been here at Invesco for 6 years. At Invesco, we're a very large mutual fund company with $1.5 trillion of assets under management. But for real estate, we have about 86 billion. And unlike a lot of our brethren, we have 20 funds across the whole risk spectrum. So from a core fund to a value fund to a mezzanine fund. So we're doing development, buying core, and everything all over the world. We're in 16 countries. I would say in the area of residential, we're doing, we used to be mostly a apartment company for residential, but now we're doing normal apartments. And then, you can go to college and live in one of our student housing buildings, then graduate, move into one of our affordable housing buildings because you're starting off as a school teacher in New York and don't have much money. And then you decide you want to go work on Wall Street, so you go live in one of our luxury apartment buildings called Strata. And then you're like, oh, I need a second home, or maybe I'll buy go rent a mobile home park in Florida. And then you have some, elderly parents that are going to move into our senior housing. You decide you're going to have kids, so you can move into one of our single family for rent. And so we're really doing the whole life cycle of residential. And then on top of that, we own probably about 5 million square feet of office in New York City. I'm glad to talk about how that's doing. And we last year bought about 4 billion of industrial, and we bought 1 billion of self-storage. So beds and sheds is the name of the game for this year. So I'll pass it on.
Thank you. Yeah, it's amazing. It looks like you're touching all the food groups, and you have a macro strategy, which we can talk about afterwards. Brian, you want to jump in and tell us a little bit about yourself and about PCCP?
Sure. Yeah. Thanks for that intro, Shimon, and thanks for having me on the panel. Great to share the stage with Sharif and Rob and James O'Neill. So Brian Haber, I'm a senior vice president with PCCP. I've been here for about 3 years now, and in the real estate investment or investment banking space for about a decade. PCCP is a only U.S. focused real estate investment firm. We currently have about 15 billion of assets under management. We've been in business for about 23 years. So solely focused on real properties. So we don't do any won't own any REIT stocks. We won't do any CMBS investing or things like that. And our business is split pretty evenly, 50-50 or so, between our lending and our equity and ownership platform. On the lending side, we originate and asset manage loans for a variety of different debt investment buckets, everything from core plus lending on more stabilized assets where pricing can be as low as the low 200s to some more gamier transitional and development loans, which can price as high as 800 to 900 basis points over LIBOR or SOFR. And on the equity side, similar to Rob, sort of a wide variety of risk and return spectrums. In our equity business, it's everything from core plus investments, where we're more cash flow and basis oriented and generally won't leverage more than 50% of our positions, and we'll sort of solve for low teens type returns, to more opportunistic investments. And then I'd say at a macro level, I think we are thematically bullish on certain sectors like logistics and housing, like you mentioned, Shimon, both in New York and the gateway markets and the high growth secondaries. But as largely an up fund investor. We still are very tactical, and we'll jump in when we think the buying opportunity is right, even if there is going to be some headwinds in the near term. So we've bought mid-block office in New York during COVID, and we've bought office in the energy corridor in Houston, but at the same time, continue building logistics and garden style apartments in places like Phoenix and Raleigh and Charlotte and that sort of thing.
Awesome. Thank you so much. And we'll talk about some of the debt and equity that you guys have done hopefully soon. Sharif, I would like to hear more about you. I mean, you have a great background and a fantastic company that's mission driven. So we're happy to hear about it.
Thanks, Shimon, and thank you to you and your team and Vic for inviting me today. Excited to be here and love the coffee and cap raise. Actually, my background, I used to attend this session as a banker with Chase, doing the CTL loans on the balance sheet, and really kind of got the rent stabilized strategy to acquire NOAA. So about 4 years ago, founded Dantes Community Partners with my partner Boo Benitier. We're a family of companies focused on buying, building, and preserving workforce and affordable housing. So we say our residents make less than $85,000 per year. We're focused on right now the Mid-Atlantic region. So we own assets as far south as Richmond, and more recently closed on a deal with NYCHA here in New York City. We were part of the first bundle with Gilbane. We recently closed the Linden housing projects with Douglaston and L&M. And we'll be closing our first transaction with NYCHA as the lead developer at the end of Q1. On the acquisition side, we launched our first fund last year, and so we've been aggressively deploying capital and more recently acquired a 930 unit asset in District Heights, Maryland. It's a core asset to our strategy of preserving affordable and workforce housing. Rents in place for about 50% AMI. We put a covenant in place for about 20% at 50% of AMI and 20% at 80% of AMI. And the plan is to inject fresh capital at the property. We're spending about $8 million on the asset, along with improving all units. And of course, what's core to our impact strategy is really providing year-round resident services and programming at the site for our residents. And so that was a tremendous deal. That was $172 million TDC with partner in a joint venture partnership with Jonathan Rose and L&M as our co-GP in the fund.
That's great. Thank you for that. I mean, again, it's very impressive what you're doing. It's not just about returns; it's also about mission. Sure. And I know Rob did that as well. And actually, Rob, let's talk a little bit about the different buckets that you have. So, of capital, I know that, for example, you guys invested in, I think it's 888 Broadway, and I think it was with Normandy, which is an office building. On the one hand, beautiful location. On the other hand, you do affordable housing, and you also have that mission-driven side to what you guys do. And you bought a big portfolio from us last year, and you bought and you did another deal with L&M, a few years ago, north of $1 billion. So how does it work, and what do you see in these two extreme deals, Rob, in terms of, on the one hand, it's office or prime office, on the other hand, it's affordable housing. Tell us about what you're seeing there in terms of investments and how you make these decisions.
Yeah, so what drives that is mostly, kind of we have a group of strategists and teams data scientists at Invesco that help us formulate our macro investment strategy across the country. And then with the help of all these data analysts, today it's like investing with GPS versus an old paper map. And so we use that information to then help drive our micro strategy. So it's both investments are actually in the same fund, but for ABC Carpets, right, that was the death of retail. So we scrunched the department store down to one floor. And then it's the rise of innovation office. So we leased the top floors to Netflix and Glacier, which is one of the largest technology companies out of Australia with a $90 billion balance sheet. So it was the conversion of obsolete retail department store into innovation office. So that, and it was obviously a great location on 19th and Broadway. So that was the trend that we took advantage there. And then going back up to the deal we did with L&M, the Putnam portfolio that we bought for $1.2 billion from Brookfield, as well as the Bronx deal that we did. There, again, we took advantage of some, very good macro trends in technology. So for the Putnam portfolio, we put that into an Article 11, which reduced our taxes for 40 years. And one of the biggest problems facing real estate nationally is, all our state governments have to pay for the pandemic one way or the other, and the best way is to raise our real estate taxes. So with New York City, and it's Article 11, we can eliminate our tax risk for 40 years. And then we also put these programs for the Putnam portfolio into AMI, and we're able to skirt around the rent stabilization board, extreme limitation on rent increases. And so our rent increases are going to be moving with AMI, which is set by HUD, which really tracks inflation. So I'm getting inflation adjusted rent increases, and I'm controlling my expenses with real estate taxes. And then what we're doing is layering on top of that all new technology, because a lot of affordable housing was run to create tax losses. So we're going in and putting in new boilers. A few of our buildings up in Harlem, we're making carbon neutral and getting rid of all fossil fuels at the properties. We're putting in new facades, which significantly reduce my energy bill by 25%. And then we're also putting metering on all our pipe, because these old buildings leak like sieves. So we're reducing our water bill. And then we put it on the Invesco insurance policy, and that saves $1 million. And then we're using artificial intelligence security systems, which instead of having manual people looking at CCTV screens, you're using AI scans that now look at motion of people and can detect where there is crime, and that significantly reduces our security costs. So by using technology, ESG, environmental conservation, and then we're providing on top of that renovated apartment units to affordable housing, 7% formerly homeless families. And so we're doing double bottom line investing, generating high returns, but creating more affordable housing for New York. And so it's a great business model. We'd love to do more of it.
That's great. I mean, you're basically leveraging all the aspects of your platform to create value in each one of the assets that you buy. I think super smart and super effective. And let's stay on the subject of affordable for a second. Sharif, do you mind talking a little bit maybe about Linden Housing in Brooklyn, a project that you recently took over, and tell us what you see there from an investment perspective, to the extent that you can, about what you see there from an investment and mission perspective. That's an East New York project I think you were involved in recently.
Yeah, I wasn't really on that deal, so I can't speak that in depth on it. But essentially, private capital and private balance sheet to facilitate these critical needs. Ultimately, engaging with all the residents to continue to preserve their affordability, right? So you're converting the Section 9 housing to Section 8, which allows for the project-based vouchers, and ultimately that provides fixed income for the owner to service the debt. That's ultimately working to improve the assets, right? And then, of course, working with the residents and providing resident services and providing wraparound services to enhance the overall environment of which everyone lives in. So it's really a true impact play, and it's a great tool for the city to leverage private capital to really reinvest in their assets and their infrastructure. and it's a great long-term investment on behalf of the development team. So great deal nonetheless, and very excited to be a part of that.
That's great. So leveraging your capital, other people's capital, your partner's expertise, and the city's willingness to work around that for the benefit, essentially, of the tenants at the end of the day. Again, mission driven, and that sounds like a win-win to me. And the website, and I looked at what you do, and I know what you do to an extent, and some of what you do is also industrial. I think you had one deal, if I'm not mistaken, in Georgia. Would you be able to tell us a little bit about what you saw in that segment, and or in the industrial in general, or any other equity investment that you guys have done outside of New York recently?
Yeah, absolutely happy to. So I think on the industrial side, I mentioned earlier, we have our thematic sectors and investments, and then our more tactical ones. And industrial, with the e-commerce revolution, and folks wanting, more goods delivered to their homes faster, was a trend that we've believed in and have been investing in significantly and allocating capital to probably for the last 7-8 years or so in a very meaningful way. And we've probably built somewhere between 40 and 50 million square feet of spec industrial warehouses, primarily all across the United States. So these were trends that sort of existed before COVID, but were accelerated greatly during the pandemic as consumers sort of shifted their spending patterns, with less money spent on services and eating out and vacations, and more money spent sitting at home, ordering things from Amazon, redecorating their house, and things of that nature. And with the major companies sort of competing to win consumers in that space, speed of delivery and availability of products has been paramount for them. So that's really led to a boon in demand for logistics and warehouse space. On the equity side, we're exclusively a joint venture investor, where we're the LP and we're partnering with either local or national development partners. And on the industrial side, we've have had a sort of a wide range of different investments that, as you mentioned, it can be in Georgia or outside the port of Savannah, or the other sort of top 50 but 30 to 50 national markets. But we've also been focused on infill investments too. And just a couple months ago, we closed on about 40 acres of land in Bayonne, Bayonne, New Jersey, for a last mile logistics facility that has New York City skyline views, and will really be that, for that same day or even 2 to 4 hour delivery that, Amazon's competing for now. And I think, with the passage of time, the deals are getting more competitive. Land costs have run very quickly. Sort of unlike New York City land that you mentioned, and industrial, when you're just building 4 walls and a roof, when rents move, land values move very fast. And we're also seeing construction costs move very quickly. What started with timber, driven by housing demand and supply chain issues, has now sort of affected almost every element of the construction side, whether it's steel, concrete, labor shortages, etc. And we're often, going one exit further out on the turnpike than we did for our last deal. So I think the underwriting is getting a little bit more competitive and stretched, but at the same time, we really don't see the demand growth and leasing slowing down. So we're sort of continuing to build out in that space.
Yeah, I think you mentioned some interesting points here in general about industrial storage warehouses. I think that in New York City, for example, we know that many of the M zone properties were rezoned over the past decade plus, and so there's a lot less of them, and that creates a supply constraint, so to speak. And I agree with you. Prices for that specific market, even New York City, has been gangbusters. I mean, you saw close to $5 billion in warehouse, industrial, and storage in New York City this year, which is amazing to me. And I want to go back to the debt side and talk to Rob for a second, if you don't mind, Rob, talking about the deal you did on 125th Street with a smile. It's a beautiful location. It's a great building, but it has a lease up risk. And I was wondering how you guys looked at it, and why did you make that loan to an extent, to the extent that you can talk about it?
Yeah, sure. Obviously we own 2,000 apartment units in Harlem, and that really stretches from affordable housing. We own the Heritage on the corner of the North, and then we also, with a joint venture with Avalon, have our Avalon Morningside Heights property, which is closer on the campus of St. John's Vine in Columbia. And I would say that Harlem has been a slower market to recover than south of 96th Street. Our higher end south of 96th Street assets, are 100% leased with rising rents. And we're seeing kind of a slower secondary recovery up in Harlem. But we are confident that that market will come back. And because we have the data points of our high-end Avalon Morningside Heights assets as on the high end, and then we have our Putnam portfolio on the more affordable end, we were able to triangulate into knowing that that property will be successful. There's a lot of life science and medical university professors up there in Harlem that want to have high quality residential options. So we really understood the tenant base well. The sponsor has owned the land for a very long time, and is very deeply invested up in Harlem as well with involved. And so we were able to get comfortable with taking that risk based on understanding the leasing market up there, the pace of absorption, and triangulating into the rents, and confident that we fully lease.
Rob, we can't hear you.
Oh.
Okay.
Can
Okay.
you hear me now? Sorry.
Yes, we can hear you great now.
Oh,
Looks like.
should I repeat what I said, or?
No, you're good. You're good now. You're good now. And one of the questions that we have from the people watching is related to the macroeconomic situation, interest rates that are about to go up, right? And I see Sharif saying, yes, that could hurt us. Inflation, unemployment. So in terms of macro indicators, where do you see 2022? How do you prepare for it? And what is your investment thesis moving forward on this end? And anybody, each one of you can take it, whoever wants to start.
I can jump in. I can jump in. I think the data that you provided in your presentation was spot on. We focus a lot on multifamily outside of New York, and we've been seeing cap rates really in the impact space and in the which we're saying workforce and affordable spaces really coming down. I mean, I think we're now seeing sub 5 cap rates going in for acquiring assets, and obviously now just even kind of through the first month we're about 30 bips wide on the 10-year Treasury from really end of year, and so you're already starting to see that impact, and ultimately it's not like the cap rates are expanding, right? I mean, it's still compressed, so you're still kind of dealing with these tight macro factors, and you have increased cost of your renovation work, and so it is making deals tighter to pencil. You've got increased competition. A ton of money has come in, especially really for the workforce and affordable space, just given how resilient it was during COVID. And so a lot of competition is coming in, really driving pricing up, and it makes it difficult for firms like us that have that preservation goal in mind to compete. So ultimately what it's going to take is partnerships with like-minded sellers that might leave 5 or 6% on the table or whatever, to work with a group like us to make sure that we can execute, we can close on with certainty, but also deliver the preservation and impact that we're saying we're going to do. And I think that's going to be it's going to be interesting to see how the sellers reflect, if they're really going to if they're clearly taking top dollar, or if they're going to work with firms like us to execute transactions. And we're seeing that right now, where we're not high bid on a deal, best and final. But we can deliver certainty and deliver a quicker closing time. So we'll see how that plays out in the seller decision. But it is getting tight, and it's making deals a lot more tough to pencil.
Yeah, that's interesting. When you work in a regulated, so to speak, environment, in some cases you have an incentive to, so to speak, build a deal with the agency, with the right subsidies, with the city you're in or the state that you're in. And a seller can benefit from that a little bit from a pricing perspective if they're willing to work with you. I completely get that. And you're right. I mean, I get that inflation and interest rates create the uncertainty that's not usually helpful for sellers in a way. Rob, Brian, any comments?
Yeah, I wanted to point out that, I mean, one of the reasons why New York City has higher cap rates is because we have this rent control, rent stabilization, issue where it's been zero, I don't know, for the last 5 years. Meanwhile, as a landlord, we're going to start seeing our energy expenses, labor expenses have rapid inflation. So our top line is flat, where our expenses are going up and our interest expenses going up. And I think we're all getting hit this year with increased real estate tax bill.
Yeah.
And so, the city is, if you look at the, National Pension Fund Investment Index, it shows New York City performance in multifamily investing for the last 10 years at the bottom of the chart of the 50 top cities in America. And so when the large investors, look at their macro models and say, where do you want to invest? Literally, New York City has earned a spot at the bottom of the list where money goes to die. And so I think Eric Adams and the city council has to make a choice. Do they want investors running away from New York City multifamily, or do they want them to come here? If they want them to come here, they have to make investing in New York City multifamily economical again. And it's not economical when rents are flat and you have rapid inflation in your operating expenses. It just does not work. And we now have a 10-year track record of New York City underperforming all the other national multifamily markets.
I think that creates an opportunity, Rob. Yeah, that creates an opportunity. I think you're spot on. But in reality, I mean, if a kid like me growing up in the DC metro area, now living in New York and wanting to own here, I'm like, wow, this is the best opportunity to try to get in. I mean, you're seeing assets traded $150,000 per unit in New York City. I mean, the replacement cost is triple that, right? And so if you could figure out how to structure your deal in New York and work with the city, like you mentioned earlier with Article 11s, it might take more time. You might have to get more comfortable, underwriting to a negative NOI for the first, however many years. I think the legislation will chip away a little bit. But just looking at again, macroeconomic factors, supply and demand. I mean, you cannot build it at the same number that you can buy it, right? The pandemic has proven that you have an increased population of folks kind of falling into these rent control, rent stabilized buckets, right? And so the factors are there. The demand is there. You're going to stay leased. I mean, we've got waiting lists for all of our properties. And ultimately, if you could figure out how to structure the deal and make it pencil, it's going to take time, but you can get deals done, and you can get really good deals done in New York. It's going to take time. And again, it goes back to, Shimon and Vic and team is working with the sellers to kind of put together a deal that both parties are working together to get to the finish line. It's a little different than some of the transactions that's on the open market outside of New York, because it really does take multiple partners to get it done. So, but there is opportunity.
Yeah, I agree with that. I think, Sharif, you hit it right on the head with regards to the opportunity. And Rob, I 100% agree with you that the city has a mandate now. They need to increase, rent rates substantially. And Sharif, you alluded to the possibility of changing some parts of the law that will make rent stabilized more attractive, because my concern is that landlords have zero incentive to put money into buildings. So my concern is dilapidation rate. And my concern is that in 5 years, this doesn't happen overnight. In 5 years and 6 years, 7 years, we might find ourselves with a lot of inventory that's dilapidated, with no interest from the landlord side to put money into buildings. And this has to somehow change. So I agree with both comments, but I do agree that it's a great opportunity. And if you look at the numbers today on a price per foot basis throughout the city, they're definitely at a very low point compared to the past decade.
Yep.
Brian, anything that you want to tell us a little bit about inflation, interest rates, New York City?
Yeah, absolutely. I think a couple of recent equity deals we've done have been in the New Jersey waterfront. And I think part of the thesis there was the ability to sort of draft off of the immense recovery in demand growth in New York City in a little bit of a more predictable regulatory and expense environment. And I think the bull case for demand in New York City housing is as strong now as it's ever been. And I think Rob mentioned the stellar performance of their South and 96th Street A buildings. And I think we're seeing a very strong performance of doorman buildings, going back to everyone living their life on Amazon and needing lots of packages now. And I think it's all happened at a point where we still have physical office occupancy in the 25 to 30% range. And we haven't had these big tech campuses that Google and Facebook are opening up take occupancy yet. So I think there's, a very strong case for a continued sort of bull market on the residential demand side, and in the New Jersey luxury waterfront. You can sort of capture that demand in a more predictable operating environment, which has been interesting for us. And then on the macro sort of forecasting side, I think we really approach that with a great deal of humility. I think it's hard in normal economic times, but now when it's government intervention on policy and pandemic as big of a driver as anything else out there, I think we just know that we're not going to be able to call it correctly. And I'm thinking back to a couple multifamily development deals that I personally was working on down in the Carolinas, where we were under contract with land closings in June and July of 2020. And we were doing those for a more long-term oriented separate account. And their view was, the liquidity's frozen up in the markets. We're staring down the teeth of a pending recession. The vaccine was far off on the horizon and not yet a reality, or something that we had a high degree of confidence that was going to come and change things. And the reason we were able to sort of convince ourselves and them to do these deals was, well, we'll save on costs building because materials and labor will be cheaper. And historically, if you've had high quality locations and you build good product, you've been, one of the only new buildings to deliver when supply slows down during a recession. And as long as you're not over levered and you can hold long term and you believe in your project, you'll be successful. And now fast forward, almost 24 months, we're so glad we did those deals for all the opposite reasons we thought back then, right? Costs have run, but rents never missed a beat. Cap rates are down 100, 150%, like Sharif mentioned, and Raleigh and Charlotte. So I think that sort of informed our view of just, let's try to do good deals and let's focus on what we can focus on. And we know that we're not the best macro predictors out there. Yeah.
Well, thank you for that. And I know we have like a bunch of questions from the audience here, but we have 2 minutes. So anybody we didn't answer their question, we're gonna make sure to send you our own answer up to the panel. But I really want to take these last 2 minutes to ask each and every one of you. We're gonna sit here in a year from now. Okay, to the extent that you can predict in a sentence or two, where do you think we're going to be real estate wise at the end of this year, the beginning of next? Anybody who wants to start, go ahead. Sharif, you're smiling.
Yeah, no, I'm very optimistic. I've got big goals this year, big acquisition goals this year. And so I suspect there's going to be a lot of activity. You've got a lot of owners that want to get out and cash out, and a lot of groups like us that are aggressive and opportunistic that are coming in with fresh capital. So I think it's going to be a really big year.
Thank you.
I totally agree with that. I think you hit it early in your presentation, Shimon. The debt markets are back in a very aggressive way. On the lending side, we're seeing a lot more competition from banks and life cos that were very cautious last year. So liquidity and capital are there for people that want to make investments. And I think that with the continued acceptance of what COVID means for everyday life and whatnot, will lead to higher transaction volumes, more people back in the office, and more appreciation for high quality assets.
Yep.
Brian. Rob, what do you think? A year from now, where are we going to be?
Yeah, it's the roaring 20s. It's going to be great. And things are, especially I think New York City, which was hit very hard with the pandemic, and I think flags a little bit the rest of the country. People ask me, "Oh, all our offices are empty." I'm like, "Yeah, but all our apartments are full,
right?
And we're selling condos and co-ops like crazy." So everyone thought that no one would want to live in New York City anymore because they were all going to move to Florida and Nashville and work remotely. But clearly people still love living here, even though they don't have to come in the office. So I think that really speaks to New York City attracting the best and most creative minds in the world and being a place where everyone still wants to be. And so I continue to think New York City is the center of the world. And I'm hopeful that Eric Adams and Kathy Hochul will realize that if they don't make New York City a business-friendly place, the businesses will continue to leave, and they have to really save Midtown Manhattan, which is a complete ghost town. And if they don't save Midtown Manhattan, their tax base for the city and the state will disappear, and we'll be in very deep trouble. So I'm hoping they are successful in alluring companies to come back to New York because the people are here, and then it'll be a great city to invest in again.
Thank you. So a lot is riding on Mayor Adams in New York City, and I want to take this opportunity to thank you. I'm very grateful you agreed to participate here. This is was very informative for me, and we all at Ariel look forward to speaking with you and your teams very, very soon. And I want to remind everybody on the call that we're doing this in partnership with Legal Outreach. Please check them out. They're a fantastic organization, and we're grateful for you for being here. So thank you so much, and this concludes our presentation and panel discussion. Thank you, Sharif, Brian. Thank you, Rob.
Thank you.
And we'll continue to talk soon.
Thanks, everyone. Take care.
Thank you.